Hi everyone, I hope you're all doing well, and today we'll talk about free stocks to buy in August 2020. This is the most popular video series that I run on the channel, where every month I talk about free stocks in the US stock market that I'm looking to either add into positions that I already own or enter new positions into stocks. And I will talk about these three companies today, the three that I've selected. And before I get into that video, guys, thank you so much for the support on the channel recently. We are pushing towards 3,000 subscribers. So if we can try to get to 3,000 subscribers within the next 2 weeks, that would be absolutely amazing. And the challenge for you guys is if you can try and hit 200 likes, that would be absolutely amazing. And also in the comment section down below, comment the free stocks that you're looking to buy in August 2020 as well. I always like checking out some new stocks. So yeah, a lot of my new recent stocks have come from you guys. So if you could do that, that'd be absolutely amazing. So I can just see what some of you guys are buying. But we'll get stuck into the free stocks to buy in August 2020. So number one is the stock that I'm most likely going to buy. It is a Chinese stock. It was featured in my free Chinese stocks to buy series. And it's a company called Huya. I also have quite like that name. And yeah, it's a Chinese company. It's listed on the New York Stock Exchange. And I know a few of you guys, when I made the video, were a little bit nervous about Chinese stocks and problems that they might face. And I totally agree. There could be potentially some problems with these companies, and how China isn't and US aren't best friends at the moment. But to be honest with you, it's been like that. The relationship's been like that for a very long time. And I think that a lot of it will eventually get brushed under the carpet for a little bit, a few months, maybe a year, and it'll go into something else eventually. So yeah, there could be some heat in the short term, but we talk about long-term investing and talk about the actual the companies itself and how does this company do. And there's some great Chinese stocks out there. You have to look at what my investments have been in Alibaba, and I'm up 50% on that. You have to look at JD. I'm up 200 and something percent on that. So it's not a market to be scared of, because when you look at the Chinese market, it is the one of the biggest economies out there, one of the fastest fastest growing economies out there. So to have some exposure in a really quick, strong economy is a pretty decent idea in my opinion. So for you guys that don't know what this company does, basically, if you've heard of Twitch, basically it is Twitch but in China. So Twitch is, I think actually Twitch got bought out by Amazon, but yeah, basically Twitch is a live streaming site. And obviously with live streaming, what you're thinking is gaming, you're thinking esports, and the massive growth in esports right now is huge. Like, I think some of their events are getting like nearly more views than what the Super Bowl does, which is absolutely crazy. So there's a lot of potential for this live streaming, especially esports, over the next 5 years. So it's a big growth area that we're going into. And obviously it's based in China. It's only really got one competitor, and it has a potential to actually merge with that competitor, so that's pretty good. The way they make money is by users actually giving gifts to like the content creators that that actually are making the content on the website, and also it's looking at ad revenue as well and increasing that up. But it's done really well through this model that it currently has. It's currently trading at $22. It did have a little bit of a drop recently, and it's kind of been a flat stock. Like, the price has kind of been up and down recently. It's not really moved too much, but it's basically been flat since 2018, since its IPO. So I think anything below its IPO price is a pretty decent buy in my opinion. And like I say, it's the one that I'm most eager to buy. I would be very tempted to buy this one as soon as possible, really. It trades at a P of 59, which isn't too bad for a growth company. Forward P of 22, which obviously is a pretty cheap P when we talk about a growth stock, which we'll get onto in a little bit. Now, when we look into the earnings, this is what makes it, it's a growth company. It's going to be growing. Growth and profit changes up quite a bit, but we'll call it 30% growth of revenue, growth of 30%, which is fantastic. There's not many companies out there at a forward P of 22, and you've got the growth of 30%. It's also already making profit, and that growth, the profit as well, is set to jump up quite a bit. I think it's set to jump up like 50% some years, even a little bit more. So it's going to start raking in a lot of profit as well recently. So yeah, growth is fantastic, profit's fantastic on the company as well. Balance sheet wise, a growth company with no debt is one that I really like, and we've got no debt on this company as well. balance sheet's pretty healthy. It's got 10 billion in cash as well, so it's a healthy amount of cash. So a fantastic balance sheet on the company. And also, when you look into a lot of these Chinese companies, you want to be seeing if Tencent or Alibaba own any percentage in them. Normally, a lot of these Chinese companies have a big backing from one of them if they're a pretty decent company. And Tencent does own 36% in the company, which I believe recently it actually increased its stake in Huya. So that's all obviously a positive sign, owning that much percentage in the company. And like I say, the potential that Tencent owns this company and its main competitor could lead to a merger down the line. But yeah, I think that obviously from Tencent's point of view, it might get to the point where if this company is doing really well, it either merges it or it completely buys it out. But yeah, very, 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 very good company, and it's not really a negative, apart from it being, I guess you could say, a Chinese company, which I don't even know if you can call that a negative, but generally a pretty solid company there at number one, and it's the company on this list that I am the most eager to buy. Number two is Revolve. Revolve is a e-commerce fashion play. It's a bit like Boohoo, so I'm kind of holding off because of how much Boohoo. You guys know how much Boohoo that I bought on this channel like 2 weeks ago now, when we had the kind of like the Boohoo scenario, and I was pretty much doing Boohoo videos like every night. But yeah, Revolve's kind of like an e-commerce fashion play. It's a little bit more like towards the middle class, so the prices on the website are a little bit more expensive than what you're talking about a Boohoo kind of situation, but still means there's pretty good profit margins in a lot of these products. And the way that it also sells these products is by social media. It pays influencers like on Instagram, and also it is looking at moving into TikTok as well. So it's basically a good high profit margin company, good how it manages a lot of its social media. This is where a lot of the other companies have fallen down, and it is, you know, ahead of the game in this scenario. And also it uses a lot of technology to identify trends. It also sees which products are doing really well, and it also stacks them in the inventory ahead of schedule before like the demand gets really high. So it's also looking at making it some of its own products, which also mean better profit margins. So overall, it's a really well run company with the kind of new kind of management in there, not the kind of old management where you see, you know, the stores like Macy that are struggling. Something like Revolve is a new generation of e-commerce and clothes shopping online, and this is kind of where you want to be investing rather than them old kind of brick and mortar stores. It IPO'd about a year ago in about June. It did IPO and it got to about $40, and then eventually it's been pulling back since there. It's a company that is currently at $15, and right now when I invest into Revolve, I am looking to make over 100% gain on this one, and that's where I think it will be worth in, you know, 2 to 5 years. I think that I potentially could make 100% on this, maybe even 200% in that range. So it is going to be a bit of a long-term hold, a growth company, and I think it should do quite well. It is a growth company. It has 20% revenue growth. EPS growth is pretty good as well. So yeah, fantastic numbers coming out of this company. It was a clean balance sheet, but it did take on 30 million in debt. And that was due to the COVID-19, just to help it see it through, which obviously it's a good decision. You know, it's better to have the cash on the balance sheet ready than be scrambling to get it when everyone else is scrambling it. So I don't mind that. So yeah, it did take 30 million in debt on, but it used to be a clean balance sheet, but it's still okay. It's still got 100 million in cash, so it's well covered on the cash to debt front. If it wanted to, it could probably just pay off that debt now. So yeah, our balance sheet is still pretty healthy from that terms of view. We also had insiders buying, which is a great sign. I think the one of the co-founders is still in there. I think both of the CEOs were both buying the shares, if I remember correctly. But in general, buying shares in the insiders is a positive sign for me, because I think that it really confirms that the people that are managing the company know this company is a cheap company, and that's why they're buying shares in it. So I am a big fan of Revolve at these sort of prices, and like I say, I think it's an easy 100%er in 2 to 5 years. And number 3 is a company that I've not covered on this channel, which is a company called the Cheesecake Factory. And as you might guess, it makes cheesecakes and it sells them in a factory bean shop. So it's a very easy company to talk about. Yeah, it is the Cheesecake Factory. It also does own some restaurants, which it is looking to expand. Obviously, this is a company that is being hurt by the coronavirus, with it being a retail store, and I'm not a massive fan of the retail space. But obviously it's kind of a food kind of restaurant place, so it does make it kind of a little bit different from an actual like retail shop. But either way, obviously it's been hurt by the COVID-19, less traffic going into stores. Obviously with Cheesecake Factory being in malls, obviously the malls are being shut, but it seems to be doing okay with deliveries, collections, so it should see itself through. Why this is more of a value stock, where we've been talking about the other two have been growth stocks. This is a value company, so we're talking about, is the share price going to increase because it's sold off so much? Because the fundamentals of the company, like growth, dividend, revenue, they're all strong. That's what we're looking at with this company. It's not all about growth on this one. And yeah, when you talk about how is this stock being affected on the share price, it has been affected. So we did see a massive drop because of the COVID-19. It had dropped previously before the COVID, and then the COVID sent it down even more. But this company used to be, trading up in this, the $60 range, even a little bit higher than that. So it's now trading at $24. Pre-COVID-19, it was about a $40 stock. So it's down 40% off COVID-19. So it is a massive drop. And like I say, it's a value play. So more when we look into the revenue and earnings, it's more of a flat revenue and earnings. It was growing slightly. It was set to jump when it started growing a lot of its restaurants, a little bit more, but still a bit more of a value play than the other ones. I mean, yeah, it's an okay revenue and earnings, not too bad overall. Debt to equity wise, the balance sheet has got a little bit worse. It's 90% debt to equity. So yeah, the balance sheet isn't as good as what I'd normally want to do, but it does still have an 81 million cash reserve, which fills me up with a lot more confidence. It's got quite a bit of cash to burn through. Obviously, it probably burnt through a little bit of that through the COVID-19, but still not a bad amount. It does have 380 million debt, so yeah, the cash to debt is a little bit lower than what I'd like. I would like that to probably be about 150 million in cash. But yeah, we're talking about it's expensive for these sort of companies to set up. They do tend to have a lot more debt than not other companies, like the two companies that we've shown previously. Just before the crash, it did have a 4% dividend yield, which was pretty healthy. It also had a 42% payout rate. So this dividend was easily getting paid out, which is great. And we also had insiders buying shares, which is a really positive sign when your stock's gone down as well. So management do seem a little bit confident in this one. Like I say, overall, this we talk about this one because the company has sold off so much. You're talking a big massive drop in the company, 60 down to 40, 40 down to 20, and it is massively sold off. And it's kind of one of those where we're trying to look at a company here if it has sold off too much. Obviously, you got to be careful about catching that falling knife. You got to be careful about averaging in here. But it's one of those where, has this company sold off way too much? Is this now way too cheap? And you could potentially say this company is a bit too cheap, in my opinion. Now, I would say that at the moment, this is at prices I would not be willing to buy, $24. I think that under 20, maybe 22 would be a better buy if you can get it there. I think while it's at $24, I probably won't buy, but it's quite close to where I would buy. 22 would be interesting, 20 would be a steal. If I could get under 20, I'd be very happy with that one. And like I say, I think this is a long-term hold, 2 to 5 years. And I think that if you hold this one for 2 to 5 years and you get in at $22, maybe even $20, you're easily going to make 100% return off this company, in my opinion. So overall, guys, those are the 3 stocks to buy in August 2020. Like I say, Huya is definitely one that I'm probably most likely going to buy very soon, and also with Revolve, I might add, that's a position I already own, so I might add into that depending on what happens with earnings this week. If earnings take some stocks down, then I might be buying into them ones, but if there's no drops in earnings, then I'll be looking definitely at these 3, and like I say, Revolve might be one that I add into. Cheesecake Factory is one that I'm watching very closely. Like I say, it is, even though I think if you invested now, you'd probably get upside in 2 to 5 years, I just would like to get it slightly cheaper than what it is. Obviously under 22, even $20 would be fantastic. And those are 3 stocks to buy in August 2020, guys. I hope you enjoyed the video. As always, smash that like button. Let's try to get to 200 likes if possible. Subscribe if you haven't, and I'll see you in the next video.